Welcome everybody to our 26th episode of our Bay Area Housing Market Town Hall. Today is December 8th, last episode for 2021. And today I'm so excited to have Teresa here with me. We're going to talk about 1031 exchange because for the last month, so many people had called and asked me about 1031 exchange. And you'll be surprised how many people don't really understand how to do their 1031 exchange. Sadly, I had somebody who called me and was very eager to do an exchange, and they said they just sold their property, this and that. After about half an hour conversation, and asked them like which exchange company they're with, they said, I don't have an exchange company. And I'm like, oh my God, they already sold the property. And I'm just like, if you didn't have an exchange company when you sold, you cannot exchange your property. And they said that their agent had told him that it would have been okay. So I hope, today, Teresa, you can educate a lot of us to make sure that if they do want to do a 1031 exchange, they need to, go on a proper process to make sure that they can actually qualify for this 1031 exchange and save them quite a bit of tax money right there. Now we're talking about investment property. And, I know Teresa, for a long time, we used to, when we had these live meetings, we used to go to the CCIM Northern California chapter meetings every single month. She's so great and teaching us about 1031 exchange, and I just feel very honored to have her here to share her knowledge with us. So thank you so much, Teresa, for being here.
Thank you, Helen. I really appreciate you inviting me to your presentation today to talk about 1031 exchanges.
Yeah, of course. I know, again, like I mentioned earlier, there's just so many people who have misconception about 1031 exchange. Did you say you have some slides that you want to show us?
Yes, I can share my screen. So when Helen invited me today, we thought we'd talk a little bit about, what a 1031 exchange is, how it works, and open it up for questions. So we do monthly webinars all the time to clients. So if there's ever an interest that you want to learn more about the details, please reach out to Helen and she can put you in contact with me to learn more about 1031. So we'll talk a little bit about recent developments, our role as the qualified intermediary, some of the mechanics, questions, basically how it works. As you may know, with every new administration, there's going to be changes, there may be changes, and that's been one of the biggest things that we've been working through navigating with 1031 tax-deferred exchanges. The Biden administration fiscal plan in 2022 released, back in May, that they proposed to cap the gain deferral on investment property, $500,000 per taxpayer or $1 million for married couples who were filing jointly. And it wasn't, clear at that time, what the impact would be on corporations. And, we have had several meetings with the House and Ways Means committees. Several of the qualified intermediaries are involved in this. Our president and CEO, Mary Cunningham, who's at our headquarters in Chicago, is intimately involved. She has spent countless hours, at the Hill in Washington, D.C. in live, meetings. She was past president of our trade association, Federation Exchange of Accommodators, and are working with our lobbyists. We want to protect and preserve 1031. It's been around in the section code for 100 years, since 1921. And, we're almost through it. We're almost out of the woods. We're not quite there yet, but we're feeling more and more confident every day that, we're going to make it through this without any change to 1031, but we're not quite there yet, almost. So there has been a macro study done and a micro study done at Ernst & Young. If you're interested in learning more about those, there's a website that you can visit, 1031buildamerica.org. You can have access to those studies that were done. You can write your letter to your local congressperson, letting them know that you definitely want to preserve 1031 and share your experience with that. So that being said, with every new administration, in the last administration, there was a big change. They eliminated personal property exchanges. And now we only do exchanges for real estate, for real property. So sometimes people may not realize that, people did 1031 exchanges on rental car fleets, artwork, collectibles, businesses, farm equipment, and you can no longer do that. You can only do real property for real property. And that was the only word that was changed in the code section, is adding this word real. So basically, a 1031 exchange means no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business, or for investment if such real property is exchanged solely for real property of like kind, which is to be held for productive use in a trade or business or for investment. So we are not talking about your primary residence that you live in or a second home. This strictly applies to real estate that is held for investment. It can be vacant land, single family, rental, condo, office, industrial, commercial, anywhere in the United States. So our role, when you say, well, who are we? What do we do? People, as Helen had mentioned, a lot of people may not know what a 1031 exchange is. We have a very critical role, but it's a small role that comes into the middle of the transaction. So if a client closes escrow, as Helen had mentioned earlier, and they receive the proceeds, that is constructive receipt of the funds at closing, which means it would be too late for them to do a 1031 exchange. The role of the qualified intermediary needs to be in place prior to the close of escrow on the sale property. So if you have your property on the market and you have a contract and you're in escrow with the title company, you need to reach out to the qualified intermediary so that way we can prepare documents and the funds can come into the exchange, at the closing, rather than you receiving the proceeds, which triggers the capital gains tax. So we're the unrelated third party. We're not the taxpayer. We're not a disqualified person who acts to facilitate the deferred exchange on behalf of the taxpayer, under the code section for 1031. So if you do not comply with getting us involved to acquire and transfer the property, it can, result in a disqualification of an exchange. So basically the IRS says if you want to defer the capital gains tax, you need to use a qualified intermediary to make sure that it's structured correctly. Who we are, we've been doing exchanges for over 30 years. We do qualified intermediary services when you're selling and buying investment property, and we also act as an exchange accommodation title holder if you need to do a reverse exchange, which means that you need to purchase property before you can sell your existing property. We are owned by Wintrust Financial Corporation, which is headquartered in Chicago. They have $45 billion in assets, and we do 1031 exchanges nationally. We have offices in Chicago. I'm here in the Bay Area. We have an office in San Diego and in New York. So benefits of doing a 1031 exchange. Helen, it's so funny. I mean, Helen and I are so extroverted and we have so much energy and we're so used to being in a room full of people with a microphone, talking, moving around, just so much energy. And it's so different for you. I see you, and it's so different for me because we just want to pop out of our chair because we're excited to share information with you. And being, in your little office looking at the camera is so much different. So, benefits of doing a 1031 exchange is people want the tax deferral, right? That's the first thing. They're like, holy cow, I have to pay all this capital gains tax. And I have a slide to kind of show, what that looks like. But they maybe want to diversify their real estate portfolio. They want to consolidate assets. Maybe they're looking for increased cash flow as they're getting older. They may want increased depreciation. Pride of ownership, if they're an owner user, maybe they want to own, a whole block or, houses on a street or whatever it may be, business, run their business out of certain buildings, better location. And then at the end of the day, a lot of it comes down to estate planning. So, that way, if you set up your trust and your estate plan so that your heirs can inherit properties, at the end of the day, you're either going to sell and pay the tax, or you set up estate planning so that your heirs inherit it, and hopefully, they can get some good benefit from the real estate investments that you've had. So, I could talk about this all day long. I'm very passionate about what we do and helping our clients But these are kind of the benefits of people doing a 1031 exchange.
Earlier, I was just talking to my husband because we were just talking about, oh, he's going to sell some stocks, and then he was all excited about it because that got him in value. And then first thing I said, like, how much capital gain tax are we going to pay on that? And then go back to, well, if it's real estate, we could have done 1031 exchange, but then because this is stocks, we can't 1031 exchange.
Right. That's correct. Stocks do not qualify. Interest in a partnership do not qualify. So what does qualify is, and you can do this anywhere in the U.S. So sometimes people think if they have that condo or rental house in San Mateo, that they can only buy another condo or rental house in San Mateo. Or if they've had apartments in Oakland, they think they can only exchange into apartments. Or if they have vacant land that doesn't produce any income, they can go into something that produces income. So you can go from multifamily to single family, rental, condos, vacant land, industrial warehouse, office, retail, ag land, timberland. You can have an existing leasehold interest with 30 years or more remaining. You cannot exchange into a brand new leasehold. It has to be an existing one with 30 years or more remaining. Easements, single tenant properties, Jack in the Box, Dollars General, those types of stores, triple net properties, tenancy in common with other folks, and of course the Delaware Statutory Trust.
The tenancy in common question, we actually got a few people who asked about that too. They are selling their property, they want to do a 1031 exchange and then go into another property where it's just one of the partners selling their interest. So they always ask, can they do a 1031 exchange and just buy out someone else's interest in a property?
Yeah, if you're just going to buy out interest, that's not going to qualify. That's a partnership exchange. You actually have to be able to take undivided fractional interest, tenancy in common interest in real estate. So basically, you can't just exchange into the pie. You have to buy a slice of the pie in order to have, undivided fractional interest of real property. And it's a very common question. There's a lot of people, I think, out forming funds to go buy real estate. So they're kind of gathering funds and then they want to go buy a bigger project. And you cannot use exchange money just to go into a fund, or exchange into a partnership. You have to be able to take legal title to that real property. So with that being said, one of the things that the IRS requires, one of the biggest things, most critical things is what the IRS wants to see is the same tax reporting entity that's selling be the same tax reporting entity that's buying. So if if Helen and I own property, joint tenants, tenants in common 50-50, we can sell that property and then we can exchange separate from one another because we own the property as tenants in common and with each having our own 50% undivided fractional interest. And I'll talk a little bit more about that partnership issue when you have LLCs that own property and how you can do potentially a drop and swap or kind of what a couple of the options are with that. So kind of going back to that cost of not exchanging, just kind of, looking at some facts. Let's say you purchase property for $1 million. You would deduct any depreciation that you've taken, add in your capital improvements, and today's sales price is $2 million. So if we roughly look at numbers in general, I will tell folks it's about a third. You sold for $1 million. You purchased for $1 million, and you're going to be selling for $2 million. You have an adjusted basis down here. So when we kind of look at what these tax rates look like, there's the depreciation recapture tax of 25%. There's federal capital gains tax of 20%, California state tax of 13.3%, net investment income tax, which is the affordable health care tax. That's 3.8%. So roughly you'd be paying about $400,000 in tax if you did not do an exchange. So if you just think, I paid $1 million, I'm selling for $2 million, and I got to pay $400,000 in tax. That's the number people don't like. And you can see how this quadruples depending on if you're selling for, $150,000 or $150 million. The IRS rules and guidelines for 1031 exchanges are the same. So it doesn't matter. I mean, if you're selling for $150,000, $150 million, I mean, you're looking at tax rates and requirements that are going to be the same. Everybody has the same timeline, the same rules. So as I had mentioned earlier, 1031 has been around for 100 years. It started way back in 1921. But in the mid 70s, the Starker family, and you may have heard of Starker, accommodator, facilitator, straw man, and we have all these nicknames, but our true name is qualified intermediary. But the Starker family had challenged the IRS, and they were purchasing property from Crown Zellerbeck, which is a paper mill up in Washington. And basically, you know, they had 5 years to find replacement property. And I'm sure everybody would love that now, but 5 years. So in 1984, in the Tax Reform Act, it's what clearly sanctioned the delay between the disposition of when you're selling and the acquisition of the replacement property. And that's what we all know and love today is the 45 days and the 180 days. So once you officially close escrow on the sale, you have a total of 180 calendar days. Every single day counts, weekends and holidays. And you have the first 45 days to identify the property that you're going to purchase. And basically, there's 3 general statutory requirements that we follow under the IRS regulations. And this is what it comes down to. You have a lot of black and white, and you have a lot of gray area. And the gray area comes down to risk tolerance, your risk tolerance and the risk tolerance of your CPA. So our role, we cannot give you specific tax or legal advice. You know, we can let you know, yes, no, yes, no, yes, no. Oh, that's a red flag. Go back, talk to your CPA, see what they think. What did they advise you to do? We rely on case history, you know, different private letter rulings that are out there. So in any event, property must be held for investment or for use in a trade or business for some period of time. Okay, how long do you have to sell property before you can move into it? Because a lot of people want to buy something that they eventually want to retire into. How long do you have to hold it before you can sell it again? Because the prices have been appreciating so much, as Helen had shared with us. It's like, wow, I got another offer and I just made, you know, a couple $100,000, couple million more. How long do I have to wait before I can sell it again? So what it really comes down to is your intent. Your intent is to hold property with the intent of holding it for investment purposes for some period of time. So most tax practitioners will recommend 12 months, go over 2 tax years. 2 years we know is good because there is a 2-year holding period for related parties. So if you're exchanging with your lineal descents, your parents, your children, your siblings, you do have to hold property for 2 years. And with that related party, the IRS doesn't want to see a related party walk away with cash at the end of the day. So those are kind of things to be, you know, keeping on your back burner if you're selling with your family. But in general, you know, a year, you know, go over 2 tax years and kind of consider your risk tolerance level. And if it was less, you know, we have a couple examples, but I could, again, talk for a very long time about 1031. So I'm just trying to like give some general information to be helpful so we can open up for Q&A.
There are a lot of people always also, they have owned the property for a while now. They bought another property, so then they are going to rent out their property, right? The one that they had lived in, but then they now going to rent it out. So we always advise them, it's like, if you look back to 5 years, by the time you sell, look back 5 years, if you lived in it for 2 years, you actually can qualify for the capital gain exemptions as a primary owner. But then also then the next question is like, well, I still make more than the exemption amount, 250,000 for single or 500,000 for married couple. Then can I exchange the remainder?
If they have held that property, if it's currently being held for investment, for example, for some of that period of time, you know, if you look back at the last 5 years and they've lived in it 2 out of those 5 years and they currently have as investment, then if they're reporting it that way correctly on their tax return and their CPA says, yes, thumbs up, you qualify for both, then they can certainly exchange, you know, that remaining portion. So that's kind of where we fall with that, because we're like, your CPA needs to give you the thumbs up that you qualify for this and this. And then we work with escrow because there's a couple different ways that they try to figure out that 500,000. Are they taking that cash out? Are they deducting it over here? And so we kind of just say, tell us what you're doing with the exchange portion, you know, with that part of it. But yeah, we have seen a few people definitely do that and exchange out of California. Like they've moved out of California already to another state, and then they've rented out their California property.
Yes, so that's why if you are thinking about renting out your current home, or not current home, the home that you were living in. So just remember that 5-year rule. I think some people, they missed it. We had a client who missed it. It's just like they came to us right after 5 years, and then we're just like, oh, I'm sorry. Now you cannot qualify for the capital gain tax exemption, and also can't. I mean, you can do 1031 exchange, but you just kind of like missed out on that capital gain tax exemption.
And so this exchange requirement is where, you know, we as the intermediary need to be involved prior to the close of escrow so that the taxpayer seller doesn't have actual constructive receipt of the funds. So that's where this is the critical component, that the exchange is set up, is structured as a reciprocal transfer of one property for another, you know, a sale followed by a purchase. So it's kind of form over substance, just how to sort of explain that. So I got some case studies in there, but in general, you know, what happens is once a client engages us, they're either referred to us, all of our business is referred by somebody we know, you know, either commercial brokers, real estate attorneys, tax attorneys, CPAs, clients that have attended our presentation. You know, we do educational seminars. So we kind of showcase our expertise because we've been around for a very long time. We've been doing it. It's our sole business. It's all we do every day, all day. But basically, we're going to be preparing, you know, an exchange agreement with us. We're going to prepare a separate qualified trust agreement, which is unique to us. The one thing I will say about the 1031 exchange industry is it's very low regulated. And we know we are owned by a bank, which makes us unique. But the exchange industry itself does not have a whole lot of regulation. So you want to make sure you're doing your due diligence. You're asking some tough questions because, wow, who is it that's holding my money? You know, what are they doing with it? And how is it protected in the event of, you know, bankruptcy, or, you know, who are these people? So you need to do some due diligence. You know, for 30 years, we've gone above and beyond what this says by creating a separate trust for every client, every transaction. That separate trust doesn't sit on our balance sheet. It doesn't sit on the balance sheet at the bank. So clients' funds are absolutely protected in their own separate trust. And people that know us and work with us, they know that about us. And not everybody would know that. They don't know it's an unregulated, low regulated industry. And it continues to be for whatever reason. So you just kind of have to be aware of making sure you're doing some due diligence on your qualified intermediary if you're looking to do an exchange. So we prepare an assignment of rights under the purchase and sale agreement to the QI, and then, you know, we're tasked with acquiring the relinquished property to the third-party purchaser, and then we assign the rights under the PSA and provide notice of assignment to the parties of the agreement. So we're working with your closing agent and or your attorney, you know, to make sure that all of these documents are in place, you know, by the time you close escrow on your sale property. This is just a technical advice memorandum that says failure to comply with the safe harbor requirement that we acquire and transfer results in the disqualification. So as Helen had said, you know, you can't call the next day if you've already had constructive receipt of funds and the property's been recorded. It's too late. So you have to be proactive if you're thinking about selling, thinking about buying, thinking about looking at that replacement property that you want to buy. And then here we kind of wrap it out. It's just kind of a couple flow charts there.
So there's a scenario where some clients would say like, hey, I want to do 1031 exchange, let's say next year, but I have, let's say I have $500,000 gain on this property, but I want to take some money out. So how does that work in terms of 1031 exchange? If they decide that, can I take $250,000 out of the $500,000 out? Then what would happen?
Yeah, so what happens is, you know, two of the requirements are, if you want 100% tax deferral, is that you buy property that's going to be equal or greater than your sales price. So if you're selling for, say, $1 million and you're, you know, then the IRS is going to want to see you buy property that's going to be $1 million or greater. So you can deduct broker commissions, closing costs. You know, you cannot deduct any new financing costs, but if you want, you know, once you deduct those, if you wanted to take some cash out, you had cash left over, you overfunded your loan and walked away with cash, or you buy property of lesser value, you would just be doing a partial exchange, which is totally allowable, and you would be paying some capital gains tax. So you're deferring some and you're paying some.
Yeah, absolutely.
And some of that, you know, when you are doing a partial, it's always a good idea. Well, it's always a good idea in general. When you're thinking about selling, go talk to your CPA and say, please give me an Excel spreadsheet so I know how much tax I'm paying, because you may have some losses that might offset some of that gain. And it may not even make sense that you have to do a 1031. So, we certainly don't want to, set up an exchange for you if you don't need to do one. So it's a good idea to kind of figure that out. And if you're wanting to take, some of that cash out, you can do that. You just need to let us know, prior to the close of escrow, because there's only certain times that you can take cash out. Basically, if you want it at closing, you can do it at closing or at the end of the exchange period after you've acquired all of your said replacement property.
Well,
we follow what are called
Oh, so sorry, go ahead.
Oh, no, you go ahead. Go ahead.
And we have some clients actually ask this question too, is that, hey, I don't want to put all my money into the 1031 exchange. I'm going to go ahead and cash a refi now, then sell my property. And so then I can at least get some money out. I don't have to pay any kind of capital gain tax on any money. And then I'm going to do 1031 exchange. Tell us about the risk by doing that.
Yeah, we would never advise that a client do a refinance right in front of doing an exchange, because then it looked like your intent was to pull all of the cash out. And then coupled with that, if you wanted to benefit from the exchange, somehow you're going to make up that debt difference, right? Because if you have to buy property that's going to be, like, if you take all your cash out or take out a bunch of cash, and now you come to the table to exchange, and that note has been, somehow you're going to make up that debt difference on the purchase side, right? You're going to have to buy equal or greater, and then you're going to have whatever remaining cash you have go into the new property. So you're going to make up that debt difference somehow, but you don't want it. It's never, we wouldn't advise that you do it in front of doing an exchange. Now, after the fact, after you've completed your 1031 exchange and bought your new replacement property, there's kind of two different schools of thought. You could refinance a day after and pull out your cash, or you could wait 3 months, 6 months, or a year. That's where it's, you've completed the exchange, you're done. So you could definitely do a refinance on that side with less of a risk than doing it on the front side.
Yeah, that's true. That's true.
Yeah.
We do have somebody who have a change question.
Okay.
Andrew Hernandez asked, can a parent sell 2 properties free and clear, exchange to multifamily, and also add 3 children to the multifamily? Houses, one is 300, another is 400, and the multifamily is $700,000 to $800,000.
Okay, you can certainly do that. If we go look at that scenario and you're selling property, what the IRS wants to see is the same tax reporting entity that's selling. So depending on who's on title on this property is going to go identify the purchase property. And then these children that want to be added, they could be added as tenancy and common owners. They cannot be part of, if there's a trust that owns on the sales side or an LLC, just knowing whoever you add in has to be tenants in common with you. And then if you're, you would also want to make sure that you're, for purposes of the exchange for the tax deferral, whatever your sales price is over here, like if you sold for, 500,000 and you were buying for 500,000, so you complete your exchange, although you're buying property for $1 million, you could add in those children to make up that other 500,000, if that makes sense.
Got it.
Is that clear, Helen, how I said that?
I think I got it, but I just want to make sure if they got it too. Feel free to ask that question again if you need some more clarification. Angela,
it's always the same entity, that's buying, and then you could add in other TIC owners.
Yeah, and Angela has a question as well. She feels the identification period of 45 days is too short. Anyone ask Congress to increase to 3 months or 6 months? That's a great, it would be great because it's the most stressful part is that 45 days.
Yes, it is. It is. And it would take an act of Congress to change it. A lot of people feel like they flipped the 180 days, or it should be 135 to identify and 45 to close. But no, I mean, back in the 1984 Tax Reform Act, long time ago is when they clearly established those days. And you kind of have to keep in mind the IRS's middle name is revenue, right? So they're not looking to make it easy for people to defer that tax, right? I mean, they don't make it easy. They make it very, you have certain requirements, timelines, and with every new administration, we're faced with a threat of it going away. It really is, I think that we're probably very fortunate that we do have this tax deferral. So they do make it difficult, and it is very challenging. And as Helen had said earlier, it's very stressful, especially in this environment, to find replacement property. So if we kind of move on, you do have 45 calendar days to identify. We need to have that form sent back to us by midnight on the 45th day. You don't have to be in contract. You can certainly be in contract and be open and escrow on your purchase property, but you definitely need to send the form back to us as the qualified intermediary by midnight on the 45th day. You can change your mind as many times as you want during the 45 days, but in order to have a valid exchange, you have to make sure that you can close on, one or more of those properties, something that you identified within the 180 days to have a valid exchange. So property rules are you can identify up to 3 properties, any fair market value anywhere in the U.S. Probably that's the most common way of identifying, unless you're going to be using a Delaware statutory trust. So it's either or. So if you want more than 3, you can acquire more than 3 properties, identify more than 3 properties, as long as they do not exceed 2 times the value of the property that you just sold. So if you sold for $5 million, you could identify, 3 properties at $5 million. Or whatever price you want, doesn't matter. As soon as you want a 4th property, that's where this rule kicks in. If you want, 4 or more, you could not go over. In my example, if you sold for 5, then you couldn't go over 10 million. And there is an exception rule that's out there that if you really wanted more than 3 and you wanted more than 200%, you could do that, but you have to be able to acquire everything that you identified within the 180 days. So basically the IRS has this rule because they don't want somebody to go out and identify 100 properties, right? If you identify 100, surely you could probably close on a couple of them, maybe, but those are the rules.
When you say acquire 95% of all fair market value property, can you clarify that again?
Sure. So if Helen were to sell me 5, like in my example, let's say I'm selling property for $1 million and I want to buy 5 properties. So I've gone over the 300 or over the 3 property rule. I'm going to go over the 200% rule because I want 5 properties for $5 million. So, and Helen's going to sell me she's going to sell me, 5 properties that are $1 million each. And I feel okay with that because Helen's the seller and she's going to know that I need to close on all those properties within 180 days. So I might be okay with the 95% rule. If I was going to buy property from 5 different sellers, there's no way I would do that because any one of those could go sideways and then my whole exchange would be blown. So you're taking a risk, if you're using that 95% rule. It just depends on the circumstances of the transaction.
We did have a case for properties. Identify 4 properties. We have to close all 4, and they are different sellers, and it was tremendously stressful.
Yeah. So here, what happens is we wind out the acquisition of the replacement property. Basically, we're going to get involved on the purchase. We work with title companies all over the USA. So wherever you're acquiring properties, we work with them, and towards the acquisition of being able to wire the funds. And then prepare the documents for the purchase so that we can wind down the forward exchange. I did have some slides, to re-talk about this boot because we've been talking about it. It's one of the, it's the other property or money received in the exchange that's not like kinds of the property given up and causes gain recognition. So we kind of thought this term boot, what is this? People are like, what does that mean? And there's, we always kind of throw around that it's kind of like, well, back in the, early 1900s, just throw the boots in with it. I'll sell you the property and here's the boots. So they I don't know what the boot, where that taxable name came from, but that's, so boot netting rules. So those 2 general requirements I talked about, this is a big area where people, they don't understand this. They really don't, because they think that they only need to reinvest their net proceeds. And that's not the case. That's probably one of the biggest pitfalls that we see is the perception that, I'm selling my property for $1 million, and I've got $500,000 worth of debt. And, so I'm only going to have $500,000 to reinvest. Let's say $2 million. Let's say you're selling for $2 million. You've got $1 million worth of debt and you've got $1 million, proceeds. And so you think in your mind, you only need to buy property for $1 million. And that's not the case. You need to buy, if you want 100% tax deferral, you want to buy equal or greater than that sales price that's on the contract. And then all the cash proceeds that come into the exchange need to go into the new property. So that's definitely, that is definitely an area where people are not always clear on, and neither are their real estate brokers, and they kind of use different terms than we do. So it's always good if you're thinking about doing an exchange, not only talking to your CPA, but call the qualified intermediary, call us. Don't listen to your neighbor, your friend, someone who who did this before. It's like they'll know vaguely about the 45 days or this or that, but just pick up the phone and call us. We don't charge you to call us and ask us questions about the process and how it works, because you want to make sure you're clear and you're lining everything up so that you have a successful transaction. So here you're selling, you're buying, fair market value, $100, $100. There's no debt. You have equity of 100, equity of 100 on your replacement property. So your cash paid offsets your cash received. Here you're relieved of your cash paid offsets debt relief. So you have sold for 100. You've got debt of 50, equity of 50. You buy replacement property for 100. There's no debt, and then you have equity of 100. So when relinquished property is sold, taxpayers relieved of the $50 of debt, and you can replace that debt with cash out of pocket or new financing. So this is an area too where people don't understand that you can actually use cash out of pocket. You don't have to go get new financing to make up this debt difference that was paid off on the sale. So it can be either new cash or new debt, or cash or new debt. This is equal. You're selling for 100, you're buying for 100. You have debt of 50 on both properties, equity of 50 on both properties. No issue here. This is an area, again, where we see issues. Debt assumed or new debt does not offset cash received. So in this example, you're selling for 100, you're buying for 100, you have debt of 50, now you have debt of 70, and equity of 50 and equity of 30. So excess debt on the replacement property results in taxpayer having unexpended cash. So what happens with this, if you overfund your loan and walk away with cash, that's an issue. Mm-hmm. And here's what happens. We have people, well, let's just start by saying this. Most of our clients have never done a 1031 exchange before. And no matter their level of sophistication, no matter how much property they own, no matter, no matter how savvy they are and everything, and they're busy working professionals, right? Most people that exchange are like you and I, we're working, we have children, we have families, and the 1031 is new to you, and you kind of have the concept of this and that, and you think, I don't really need an attorney. I can figure this out, and so what happens is that communication sometimes, between your parties involved, because, you first off usually have a real estate agent or broker that's going to be listing your property, so you're talking to them. You're thinking about, besides all the time that it took you to decide that you wanted to sell the property, right? And then now what are you going to do with the tax? Because you come to a fork on the road. Are you going to pay the tax, or are you going to do a 1031 exchange? And then once you make that decision, now you start looking at replacement properties, and then you start looking at returns. And are you going to get, what type of property are you going to get? There's multiple offers that are out there. You may talk to your CPA in there, and you have an escrow officer over here. And then you start talking to a lender about, what do the rates look like? What type of loan am I going to get? Well, maybe I want to buy 2 or 3 properties. I'm really not sure. And then all of a sudden your lender is willing to give you more money. And the escrow officer says, okay, here's the loan that's coming in. You've identified property. And it's like, well, you request some cash from us. The escrow officer does. Okay, we're like, okay, well, you still got some other properties identified that you're going to be buying over here. So I guess that's the only amount of cash, because that's what the estimated closing statement says. And all of a sudden you end up walking away with cash. That's why you have to be engaged in the process. That's what I tell everybody when they say, what are you going to tell me that I don't already know? And it's usually like, well, you need to sit up, pay attention, and make decisions and sign documents and, line your ducks up in a row, be proactive. If you can hire a real estate attorney to help manage through all of this, that's even better. It just, and some of these things, you're doing a lot, and it's good to have your circle of advisors that are looking out for you, that understand this stuff and come to the table prepared.
You brought it up.
I kind of lecture, like you have your lecturing points. I have my lecturing points a little bit too, where it's like, okay.
Yeah.
But it's,
and this is why you're passionate about what you're doing. And every time we have clients, we can only, as a realtor, we can only answer as much questions that we understand well, which is also another reason why we put together these kind of webinars, so not just educating consumers, but also other real estate professionals. But I'm not a 1031 exchange professional. So I always ask our client, well, call this person, whoever, asked that question about 1031 exchange rules and how that your scenario actually apply in the situation. So I think there's so many different scenarios that you can go over and we can talk about, but it's just something that you have to talk to the professional like Teresa, just go over your scenario and see if that will, this 1031 exchange apply. Just if you break the rule, is not going to qualify and you're going to be so mad at yourself. So Celine also has this question. I think Celine probably have a client. It was like, so what can sellers expect to pay for for a 1031 exchange service?
In general, for a forward exchange, somewhere between $1,000 and $1,500 is what we typically charge. Yeah, that's our standard fee. Yeah, we're a professional service provider, so we're there, to prepare documents on the sale, on the purchase, make sure funds are wired, make sure the documentation, everything, T's are crossed and I's are dotted on your transaction. Any potential red flags, but we don't provide specific tax or legal advice. That's our fee, and we deduct that fee from the proceeds when we receive it. And then I'll just jump back to partnership real quick, because this is kind of a critical thing that we see with 1031. One of the requirements, as I mentioned earlier, the IRS requires the same tax reporting entity that's selling be the same tax reporting entity that's buying. So what happens when we have clients that are in partnerships and LLCs and they don't all want to stay together? It usually involves a drop and swap. And a drop and swap is where if you've owned property in an ABC LLC, and not all of the partners want to exchange together to buy new property, you need to talk to your real estate attorney about dissolving this LLC into tenancy in common interest. And then the more proactive that you can be in doing this sooner than later is always a good idea, especially, if you're thinking about selling, you kind of know that, some of the partners may want out or they may not want to exchange, because when you do dissolve an entity into tenancy in common, there is that tax on a new holding period in terms of the California Franchise Tax Board auditing, at least here, that's my dog in the background, at least here in California, right? We see the California Franchise Tax Board heavily auditing 1031 exchanges, and they could be looking at all different things, but, on the partnership form, there's a box that needs to be checked. Did you dissolve an LLC or partnership, within the last, 12 months? So you will see, CPAs talk to clients about this and be, understanding that they are taking a risk when they do this. And it really is a risk tolerance issue of how long do you want to wait before you sell the property after you've dissolved it into tenancy in common. So it doesn't mean that you can't do it, but there can be risk involved depending on what state you're in, and a greater risk in California for sure. And so there's lots of CPAs within our chapter that we have people talk with about those types of things when they're thinking about selling. And, afterwards you could potentially acquire the property together in the LLC, and you could, transfer properties, out after the fact that way as well. But it's definitely worth having a conversation, when you're thinking about, what that entity looks like and how the ownership is structured on it when you do exchanges. I'd say that's definitely an area to be looking at. The other thing that we do is reverse exchanges. So we do two things. We're either the qualified intermediary when you're going to sell and you're going to buy, or we're going to be the exchange accommodation title holder if you need to purchase property first. So we actively do a lot of reverse exchanges. We get a lot of inquiries about them because for whatever reason, maybe you need to acquire your property first before your existing property can sell. So what has to happen is, some of the benefits of doing that, there's always benefits. It allows you to be an opportunistic buyer, especially probably more so in the commercial market. Or even, I guess, in the residential market, that you're looking for property and you're not under that 45-day pressure, right? Because you haven't sold anything yet. You're just out shopping around going, well, let me see if I'm even interested in finding anything before I list my property that's going to sell like next week. So you have no cash flow loss in your existing property because you haven't sold it yet, right? It allows like an owner user to move their business to a new location without interrupting their business. So if clients were wanting to move to a larger facility or a smaller facility, and then it also allows, clients to be able to do improvements on that property while we park it. So it really is a parking arrangement. And by that, I mean, what's going to happen is the client has to have all of the cash up front for the purchase. So if you're out shopping and looking for property, you need to have all the cash ready, either out of pocket or lender financing. We talk about the financing with the lender because the lender needs to understand that we, as the exchange accommodation title holder, are going to be taking legal title to that property. We're going to be the beneficial owner of the park property for federal income tax purposes, and we're going to want that financing to be non-recourse to us. So we have that conversation with our client and the lender to talk about that. And the timing is the same. So once we actually take legal title to the purchase property, the client now has 45 calendar days to identify their existing property, which is fairly easy because they already know what they own. And then they have the 180 days to sell it. And if they never sell their existing sale property, they only have the cost of acquisition because they basically just went out and purchased property, with the hope of being able to sell their existing property to be able to defer the tax. So we can also be the qualified intermediary. The taxpayer can guarantee or co-sign on any loan documents or debt instruments that the EAT takes on to acquire the parked property. Taxpayer can loan funds directly to us at no interest. And we basically prepare a lease agreement back to our seller, the taxpayer, so they can fully operate, manage, collect their rents, do whatever they want to do to their property, do improvements on it. And they could, there's puts and calls, document language within the document, that any gain or loss occurs while that property is parked with us. I mean, there's, lots of language, lots of documents that are involved being able to do these reverse exchanges, but there's some flexibility in some of that language depending on the nature of the transaction.
So what is the cost to do that, to do a reverse exchange?
It's a lot. So typically our flat fee is $7,500 roughly, plus the cost of the LLC, because there has to be an LLC that's formed. That cost can vary depending on what state that the LLC is formed in. But, clients at the end of the day, they may have some duplicate transfer tax issues, some other things. So, there's a big difference between, the $1,500 and the $7,500, and, it's definitely much more involved transaction on a reverse. And if you've never done a forward exchange, it can be a little bit overwhelming on that side of it.
Yeah.
But it can be done. That's what we do. This is our sole business all day, every day.
And the scheme of thing is like if $7,500 versus like you have to pay $50,000 and then save your stress, it could be worth it for some people.
Oh yeah, people definitely. If you're going to defer hundreds or thousands of dollars, paying that fee is minimal. Yeah. Mm-hmm. Minimal. So here's kind of common issues, partnership issues, which we talked about: drop and swap, held for investment. How long do I hold property before I exchange into it, or before I sell it, move into it? Improvements, related parties, vacation homes, personal use properties, split treatment. If you have a fourplex and maybe one of the units is your primary and the other three are held for investment, seller carryback notes, closing costs, lender fees, earnest money deposits. So all these things relatively come up during most every conversation, depending on, you're kind of crossing those T's and dotting those I's, making sure that, everything's going to work out and qualify for what they're trying to do. So usually what happens is,
when you said the 1 to 4 units and then they are owner occupying one of the units, it's kind of like, okay, I guess like the percentage would be by the square footage, right? More or less.
How they're reporting it on their tax return. Yeah, if they have whatever the square footage is, they.
Yeah, and then we had somebody who asked about like, hey, they've been running their business in their home, and let's say a daycare business in their home, they do live in it. Can they 1031 exchange that property?
It depends on how they're reporting it on their tax return. What does their CPA say? Are they showing it that way for the, for tax purposes?
It sounds like there is like a business owned, could potentially. So we, again, go back to like your team basically for your 1031 exchange is like besides the exchange intermediary, your realtor, but CPA and potentially also your real estate attorney. Well, thank you so much, Teresa, for sharing so much information. I know there's a lot more questions that I could ask because there's just so many different scenarios that could come up. But if anybody has any questions for Teresa, obviously feel free to contact her directly or reach out to me and I can connect you guys with Teresa. She's just been amazing in terms of like 1031 exchange expert. If you don't understand, ask her. So again, thank you so much everybody for joining us today. I know we went a little bit over time, but it's going to be recorded and feel free to go onto our YouTube channel, subscribe, and you'll get notified as soon as this video comes on. Thank you so much for watching our YouTube channel. And don't forget to subscribe to our channel, like our videos, make some comments because we're going to keep you posted on the most updated real estate news, housing market data, and also real estate tips and advice from all over the real estate industry. So thank you so much for watching and I'll see you next time.